Hello everyone, this is Ankur Chaudhary from Hitbullseye.com, and in this video lecture I'll be talking to you about the basic introduction of the financial system, its various components, and also we'll be having a detailed discussion on the money market and its various instruments in India. So first let us try and understand what exactly is a financial system. So financial system is a system which provides a mechanism by which savings are transformed into investments. So whatever surplus incomes that individuals or companies or even the government that they have, the financial system provides a mechanism by which these savings can be invested into formal market of India. Further, it plays a significant role in the economic growth of the country by mobilizing surplus funds and utilizing them effectively for productive purposes. Now, if the surplus income or the savings that we have, we are not able to invest this money into a formal market, then we keep it with ourselves, and this money or this saving rather becomes a dead asset for us. So through the financial system, we get a formal channel, an effective channel, so that this money can be used for productive purposes. Now let us look at what exactly constitutes the financial system of any country. First are the financial markets. In this, we talk about primary market and the secondary market. The primary market, of course, is where new shares are issued. The secondary market, again, when the old shares are traded amongst different entities. Other divisions of financial markets are, of course, money market, capital market, etc. Next, we have financial institutions. So we have institutions which are regulatory in nature, for example, SEBI and formerly MCX, etc. Also, we have other institutions like DFHI, which we'll see in the subsequent slides. The next component of a financial system includes financial instruments. So we have shares, debentures, etc. Assets and securities, including government securities through which government borrows funds from individuals or other entities. Next, we have financial services. In this, we include services like mutual funds, hedge funds, etc. So now that we understand the various components of the financial system, let us now see what are the various functions that a financial system performs in an economy. It serves as a link between savers and investors, right? So the people who are saving may be geographically located far apart from the people who can actually invest your money. So through this financial system, somebody located in, let us say, Chandigarh can easily invest in a company which is located in Bombay. So the financial system acts as a link between the savers and investors. It provides a payment mechanism for exchange of goods and services. So we will see that various derivative instruments like forward, futures or options again provide this particular function. Next, it provides a mechanism for the transfer of resources across geographical boundaries. Next, it helps in lowering the cost of transaction and increases returns. Now, for example, if you talk about a mutual fund, since the mutual fund is aggregating money from a lot of people and investing it all together, because the money from so many people is aggregated and invested in the market together, again the cost of transaction becomes lower and it naturally increases returns for individuals as well as mutual funds. Now we look at the first component of the financial system, that is the financial market, right? So these are mechanisms enabling participants to deal in financial claims. By the term market, we do not mean that the market exists at one single place. However, this market is a platform which can even exist on the internet or in the digital form as well. The various participants in financial markets, of course, are financial institutions like banks, individuals, companies, and also the government, right? So these participants deal with various kind of financial claims using the instruments of financial markets. Financial market, it facilitates creation and allocation of credit as well as liquidity in the economy. So as I said earlier, there are two types of financial markets. First, money market. So this is broadly the market in which short-term debt instruments are traded or sold. Next is capital market in which only long-term debt instruments are involved. Again, the next division of financial markets is of course between primary market and secondary market. In primary market, new shares or fresh or initial shares are issued by any company seeking to raise equity from the market. Next, as far as secondary market is concerned, the shares which have already been issued by various companies, they are traded in the secondary market. That is, it deals in trading of outstanding issues. So now that we understand the various components of money markets, let us take each one in detail. So first one is the money market. So it is market for borrowing and lending of short-term debt funds. As far as short-term is concerned, it includes all the funds which are maturity period, which is ranging between 1 day to 1 year. So it caters to the short-term financial needs of the economy and also helps the RBI in effective implementation of monetary policy. The major participants of money market are of course banks, non-banking financial corporations and other financial institutes. Now let us look at the structure of Indian money market. So Indian money market is divided into two broad parts. First is organized money market and second is unorganized money market. Under organized money market, this include instruments, components as well as institutions which have been established by law or work under certain rules and regulations given by institutions like RBI, SEBI, etc. As far as the unorganized money market is concerned, they are not formally recognized and do not work under certain rules and regulations set by any authority. So as far as organized money market is concerned, it has certain instruments under it. So treasury bills, call, notice, term, money market, commercial paper, commercial bills, certificate of deposits, repurchase agreements, bankers acceptance, etc. I'll be talking about each of these in subsequent slides. Now coming to the unorganized money market, as I said earlier, these are not governed by any formal authority or do not work under certain rules and regulations. So these are indigenous bankers and money lenders. So you can find such people who are giving out loans but without any formal authority. So this is a huge problem in India, especially in the rural sector, leading to farmer indebtedness. Next we have other non-banking financial companies in the form of chit funds or nidhis. So these are nothing but a form of kitties in which people contribute money in lieu of some return. But again, these are not recognized by any authority in the country. Now the Indian money market is unique in the sense that it is still having a large proportion of unorganized sector. The various reasons are that the money market is still underdeveloped and there is a huge lack of penetration and presence of organized money market in all areas of the country. So as far as the money market is concerned, it is only concentrated in urban areas and has not penetrated up till rural areas of India. So naturally there are many needful customers who need short-term fundings. However, they do not have any access to formal or organized money markets. That leaves space for unorganized money market in India. Also, another limitation is that there are large number of barriers of entry in the organized money market of India. So for example, if a company wants to open a bank, it has to have very high levels of qualifying criteria to even become eligible. So not a large number of companies are able to open banks in the country that easily. So that is why there is a lot of space for unorganized money lenders or money market in the country. In the next few slides, I'll explain the major or the more important instruments under money market. The first one is related to call money market. So it is basically an interbank money market. That is, banks generally lend or borrow money from other banks in order to match their assets and liabilities by the end of the day. So these short-term transactions come under call money market. This is a market for trading very short-term liquid financial assets between banks. So it is repayable on demand and its maturity period varies between 1 day. So this is known as call money, and then to a fortnight, which is known as notice money. The rate of interest paid on call money is also known as the call rate. So commercial bills are issued by All India Financial Institutions, that is AIFIs, non-banking financial companies, NBFCs, and scheduled commercial banks, merchant banks, cooperative banks, mutual funds, etc., to borrow short-term funds from the market. So these are nothing but trade bills arising out of genuine trade and commercial transactions. These are also short-term, negotiable and self-liquidating money market instruments. However, another important characteristic of commercial bills is that they have considerably low risk as compared to other instruments. They are purchased and discounted by commercial banks and rediscounted by financial institutions like SIDBI, IDBI, Exim Bank, etc. However, commercial bill market in India is very limited. When you compare India's market with for a developed country like USA, in USA, of course, commercial bills are very popular. Next is an instrument that is known as certificate of deposit. So CDs are issued by banks and to the depositor for a fixed period. So you go to a bank and deposit your money, and for a short period of time, of course, and then the bank issues a certificate of deposit. They are negotiable and also are tradable in the money market. They were organized in 1986. That is, they were brought under formal rules and regulation in the year 1986. And since 1993, RBI has also allowed financial institutions to operate in it. For example, IFCI, IDBI, Exim Bank, etc., which can also now issue certificate of deposits beyond the commercial banks. Next one is a very important instrument used by the government to raise short-term funds from the market. So this is treasury bills, or also known as T-bills. These are promissory notes issued by the central government for a fixed period extending up to 1 year as a device for raising short-term funds. Now RBI also uses treasury bills in the monetary policy to control liquidity in the market. Now of course, if RBI is selling treasury bills in the market, it is collecting money from people, and people are parking their funds with the RBI. So naturally the money supply goes down, the liquidity in the economy goes down. So as a result, demand will fall, and then it will bring down inflation. So these are highly liquid and very safe investments and give attractive yield, and thus banks and financial institutions invest in them. So because government is borrowing funds from you, and the government is considered to be a very safe borrower, hence of course these are absolutely low risk or no risk instruments. There are three types of treasury bills with maturity periods from 91, 182 and 364 days. There were 14-day treasury bills as well, which were discontinued in 2001. Next instrument is commercial paper. It is very popular as it is used by companies to pick up short-term funds from the market to finance their working capital or the money that they need on a day-to-day basis. So it is an unsecured instrument issued in the form of a promissory note. It can be transferred to other individuals. Various maturity periods range between 7 days to 1 year from the date of issue, right? However, not all companies can issue commercial paper. This company needs to obtain a specified credit rating from credit rating agencies like CRISIL, ICRA, etc. So the company has to be a financially strong company and has to be certified by various credit rating agencies like CRISIL. Only then will it be allowed to issue commercial paper. So during the course of this video presentation, first we saw the definition of a financial system. Next, we understood what are the various constituents of a financial system in a country. Beyond that, we saw the various functions performed by a financial system in an economy. Next, we took a detailed discussion on money market and its various instruments. So that's all as far as this video is concerned. Thank you.